Let's start with how we traditionally measure success. In the private sector, the accounting framework is built around a single overriding objective, measuring profit generation and the return on equity for investors. A public sector entity operates under a different mandate. Its primary reason for existing is to deliver services to the public, not to generate a financial return. This creates a unique performance paradox. A government agency operating at a massive financial deficit might be executing its mandate perfectly by delivering critical emergency services. Conversely, an agency generating a massive surplus might be failing its citizens by withholding funds and under-delivering on those same services. Because of this dynamic, standard ex-post financial statements, your traditional income statements and balance sheets, often miss the true operational success of a nonprofit sovereign entity. They track money left over rather than value delivered. This visual comparison shows why evaluating the public sector requires a different set of metrics. On the left, a corporate return on investment cleanly resolves to a single measurable data point. On the right, public service delivery fractures into multiple data streams. Making sense of this requires a framework specifically optimized for accountability and long-term service sustainability. To build that framework, we rely on the International Public Sector Accounting Standards Board, or IPSASB, and their conceptual framework for general-purpose financial reporting. This framework identifies two core objectives for public sector reporting: providing information that demonstrates accountability and providing data that is useful for decision-making. The IPSASB builds its reporting architecture on the specific characteristics of public sector existence, moving step by step from who uses the reports to how the data is verified. We are going to build this reporting architecture from first principles. We will identify the specific users of these reports, expand the scope of what must be measured, and apply the strict qualitative constraints necessary to keep the data reliable. To understand this, we must evaluate government accounting as its own distinct system, rather than trying to fit it into a corporate mold. Looking at this ecosystem map, we see the public sector entity in the center. On one side are the primary users of its reports, the service recipients. On the other side are resource providers, who supply the operating capital. There is a critical constraint here. These reports are designed specifically for external users, who do not possess the legal authority to demand customized internal financial data from the government. These entities are funded through what the framework calls non-exchange transactions. In a non-exchange transaction, an entity receives value from another party without directly giving approximately equal value in exchange. Taxation is the most common example. As the diagram shows, resources flow in involuntarily, but notice the output. Services delivered to individuals are disconnected from their inputs. A citizen paying high taxes might use few services, while another paying minimal taxes might rely heavily on them. This asymmetry strips the taxpayer of the direct feedback loop that exists in a normal free market transaction, where a consumer simply stops buying a product they don't value. Because citizens cannot enforce accountability through market choices or take their tax dollars to a competitor, the financial reporting framework itself must serve as the primary engine for justifying the equitable use of those entrusted resources. This diagram shows the foundational document of public sector operations, the approved budget. Notice how it forms a rigid boundary completely enclosing the entity. Unlike a corporate budget, which serves as an internal forecast or an operational goal, a government budget is a legally binding mandate approved by the legislature. It provides the explicit legal authority required to extract taxation from citizens and to expend those resources on public programs. Without it, the entity cannot legally operate. Because of its legal weight, comparing the actual financial results against this approved budget is the primary mechanism legislatures use to exercise oversight. In the public sector, statutory budget compliance represents the baseline legal requirement for discharging financial accountability to the public. This standard document is a traditional financial statement. As we established, tracking past cash flows and current liabilities is insufficient to measure actual service delivery or legal compliance. To solve this, the IPSASB framework physically expands the reporting boundary, creating a larger container called the General Purpose Financial Report, or GPFR. As you can see, this new space allows us to plug in entirely new data modules, starting with service delivery achievements. This module uses non-financial quantitative and qualitative metrics to measure actual operational outcomes against stated policy goals. It answers whether the resources spent actually achieved their intended public purpose. We also have to account for sovereign longevity. Nation-states have indefinite lifespans and regularly make commitments spanning decades, like funding social benefit programs or massive infrastructure projects. To capture these long-term obligations, a second module is added for prospective financial information, projecting the entity's future resource needs and funding sources. It is important to distinguish these IPSAS reports from macroeconomic government finance statistics. GPFRs focus strictly on entity-level accountability and performance, not on evaluating economy-wide impacts. The GPFR architecture solves the public sector reporting problem by fusing current financial performance with actual service outcomes and long-term multi-generational solvency metrics into a single record. To keep the data within this expanded GPFR architecture reliable, the framework applies a strict set of qualitative characteristics: relevance, understandability, verifiability, comparability, and timeliness. The most critical characteristic for public sector reporting is faithful representation. Faithful representation requires that the information reported reflects the actual economic substance of a transaction or event, rather than merely its legal form. A key component of this is neutrality, the absence of bias. The data cannot be selected or presented with the intention of influencing citizen behavior or steering political perception. Neutrality is supported by prudence. Under uncertainty, preparers must ensure assets and revenues are not overstated, and liabilities and expenses are not understated. But notice, prudence rejects systematic asymmetry. You cannot deliberately understate assets to create hidden reserves. The scale maintains a factual balance. These qualitative constraints act as an engine that prevents political manipulation, ensuring the highly complex GPFR data remains a verifiable, objective tool for citizen decision-making. Looking at the complete system we've built, it is clear that the IPSASB conceptual framework is a bespoke architecture engineered to solve the unique problem of sovereign accountability. This architecture is the only reliable way to track resources extracted through involuntary, non-exchange transactions. It proves that measuring a government solely by its financial surplus or deficit represents a failure to understand its true purpose. By expanding the reporting boundary, general-purpose financial reports empower citizens to look beyond the current political cycle and assess the generational sustainability of their public institutions. General-purpose financial reports serve as the structural mechanism that translates legal authority and taxation into transparent service delivery and public trust.